spot gold prices briefly approached $4,380 per ounce, setting a new record high. This precious metals bull market, which commenced in 2024, represents more than mere price volatility. It constitutes a collective response from global capital to the U.S. government shutdown, escalating Sino-American tensions, and expectations of Federal Reserve interest rate cuts. Moreover, it signals the resurgence of gold's safe haven status in an era marked by eroding monetary credibility and heightened geopolitical risks. From central banks' sustained gold accumulation as part of de-dollarization efforts, to investors flooding into gold ETFs and pushing holdings to three-year highs, coupled with cultural physical demand from India and China providing support, multiple forces have collectively propelled gold prices beyond the inflation-adjusted historical peak reached in 1980. However, the elevated gold-copper ratio, potential dollar rebound, and profit-taking pressures also introduce uncertainties to this bull run. This video delves into the core drivers of gold's ascent, the strategic intent behind central bank purchases, and potential investment risks, while examining how this ultimate store of value is reshaping global asset allocation. The dollar's hegemony faces systemic challenges. The Trump administration's tit-for-tat tariff policy has elevated global trade costs. In September, the U.S. Consumer Price Index (CPI) rebounded to a year-on-year increase of 4.1%, while real interest rates remained persistently negative, nominal rate of 4.25% minus inflation rate of 4.1% equates to 0.15%. This expectation of currency depreciation has propelled gold's resurgence as the ultimate currency, with its negative correlation coefficient against the US dollar reaching a historic peak of -0.82 in 2025. More significantly, central banks worldwide are spearheading a quiet monetary revolution. China's central bank has increased its gold holdings for 11 consecutive months, reaching 74.06 million ounces by the end of September. Emerging economies like Russia and India have also seen their gold reserves exceed 20% of total reserves. According to the World Gold Council, global central bank gold purchases reached 166 tons in the second quarter of 2025, equivalent to acquiring 5 grams of gold every second. This has re-established gold as the anchor for global reserve assets, accelerating the process of de-dollarization. Geopolitical risks are now impacting markets in entirely new dimensions. The U.S. government entered another shutdown in October 2025, leaving 800,000 federal employees without pay and halting the release of core economic data. This directly undermined market confidence in the stability of the U.S. system. Meanwhile, Sino-U.S. trade friction escalated into technological decoupling, with the U.S. expanding export controls on semiconductor equipment to China to include 28-nanometer processes. This strategic confrontation risks restructuring global supply chains. Financial system fragility has intensified risk aversion, with non-performing loan ratios at U.S. regional banks climbing to 5.2%. Liquidity crises at institutions like Zions and Western Alliance have evoked memories of the 2008 subprime mortgage crisis. Concurrently, alternative assets such as Bitcoin exhibit volatility 3 times that of gold, paradoxically highlighting gold's stability advantage. Holdings in gold ETFs have surpassed 3,600 tons, reaching a 3-year high, reflecting institutional investors' demand for asset rebalancing. The Federal Reserve's monetary policy logic has undergone a fundamental shift. September's meeting minutes revealed that 11 out of 12 voting members supported further rate cuts, with markets anticipating an additional 50 basis points of easing before year-end. This round of monetary accommodation has driven the opportunity cost of holding gold to historic lows. The real yield on 10-year U.S. Treasuries has fallen from 2.8% in 2024 to 0.5% in 2025. More profound implications stem from the erosion of the Fed's independence. President Trump publicly pressured the central bank to cut rates, even hinting at potential replacements for officials like Jay Powell. Such political interference has undermined market confidence in monetary policy credibility. As an anti-fragile asset, gold's price sensitivity to policy uncertainty increased by 40% in 2025. The physical gold market undergoes structural transformation. China's gold consumption surges by 28% year-on-year in Q3 2025, while India's gold imports during Diwali exceed 150 tons. This culturally driven inelastic demand provides robust floor support for gold prices. Furthermore, the People's Bank of China's plan to become a custodian for foreign sovereign gold reserves will profoundly impact the global gold pricing system currently dominated by London and New York. Moreover, notable shifts are occurring in the derivatives market. Open interest in COMEX gold futures reached a record high of 800,000 contracts, with speculative long positions accounting for over 70% of the total. This concentration has amplified gold's sensitivity to macroeconomic events. On October 17, gold's intraday volatility surged to 3.2%, 1.8 times the 2020 average. Following gold's breach of the $4,300 per ounce threshold, technical indicators have formed a strong bullish signal, with weekly charts displaying a head and shoulders bottom pattern. The measured target for the upward move points towards $4,800. From a valuation perspective, although the gold-copper ratio has reached a historic high of 99.7%, the ratio of gold to the S&P 500 index stands at merely 0.6, still below its 20-year average. This indicates that gold still possesses valuation recovery potential relative to equities. However, this rapid ascent carries risks. Gold ETF holdings remain 18% below their 2020 peak, suggesting no irrational exuberance has emerged. Should the Federal Reserve's interest rate cut trajectory fall short of expectations, or if significant progress occurs in Sino-US trade negotiations, concentrated profit-taking could trigger a short-term price correction of up to 15%. Central banks' gold accumulation represents a strategic response to the restructuring of the global monetary system. Following Russia's invasion of Ukraine, the freezing of Russia's $300 billion foreign exchange reserves served as a stark lesson, accelerating reserve diversification efforts among emerging market nations. The People's Bank of China's sustained accumulation serves not only to hedge against U.S. dollar depreciation risks, but also reflects deeper intentions to advance the internationalization of the renminbi. Expanded gold reserves bolster the currency's credit backing, thereby providing robust support for the promotion of the cross-border interbank payment system, CIPS. This strategic positioning carries long-term irreversibility. A World Gold Council survey indicates that 95% of central banks surveyed plan to continue increasing gold holdings within the next 12 months. This collective action is reshaping the global financial order. Historical data reveals that when central bank gold purchases exceed 1,000 tons annually for 3 consecutive years, the average gold price increase over the subsequent 5-year period reaches 87%, providing robust historical precedent for the current bull market. Despite the optimistic outlook for gold, vigilance remains warranted regarding 3 key risks. Policy reversal risk. Should the Federal Reserve resume interest rate hikes in 2026, real interest rates would rebound. Although the gold outlook is favorable, caution is warranted regarding 3 major risks. Policy reversal risk. Should the Federal Reserve restart interest rate hikes in 2026, a rebound in real interest rates could trigger a gold correction. Central bank sell-off risk. While currently absent, any adjustment to reserve strategies by major holders could trigger market panic. Technological displacement risk. Innovative products like digital gold currency (DGC) may divert some investment demand, though their market size currently remains below 1% of gold ETFs. Overall, gold's ascent reflects not merely price fluctuations but the external manifestation of a restructuring global economic order. In an era marked by monetary credit collapse, frequent geopolitical conflicts, and accelerated technological transformation, gold, as humanity's ultimate value anchor, is undergoing a historic reassessment of its strategic significance. For investors, while capitalizing on the gold bull market, a profound understanding of this transformative shift is essential to seize opportunities amidst volatility.